Hello, fellow investors, and welcome to another episode of Ritter on Real Estate, where we teach you how to passively invest like a pro. Today's guest is someone who's helped shape the education for thousands of real estate investors. You've seen him and read him through Bigger Pockets. You've watched his Landlord Chronicles YouTube channel, and you probably read his best-selling book, Raising Private Capital. So Matt Faircloth, he's been a full-time investor for 15 years. He's raised tens of millions from private investors, built a portfolio of over 2,000 units. But what makes him stand out today is his clear perspective on what's happening in the market. And he's going to share with us really what investors should be paying attention to. So excited to drill in with him and get some great insights today. So Matt, thanks for coming on the show.
Kent, thanks for having me here today.
Yeah, so I mean, just quickly, I know you've obviously, as we kind of discussed, you've been on a lot of shows. You've told your origin story a few times. Just for if somebody doesn't know who you are, give listeners, the 30,000 foot view on your 15 years of investing and what's brought you here.
Sure, no problem. I started investing in 2005. So believe it or not, I've actually been doing this full time for a whopping 20 years. So I'm in the 20-year club, but I only know a few people that are in that group. Started in 05 by quitting my day job. And just started doing some small onesie-twosie investments, single-family homes, flipped a house there, bought a duplex there, that kind of thing. Did it with all of our own money and immediate family's money, and then got through the 2008 crash and built up a portfolio of about 30 units. My wife and I worked hard to maintain and create. Then in 2011, guy that my wife went to college with, and her were doing like a networking, reconnection, like a LinkedIn reconnection thing on a conference call, just trying to get business for each other kind of thing. And then she mentions like, oh, well, my husband does real estate investing. And he says what I call the magic words, which is, real estate investing. I'd love to do that too. I just wish I just don't have the time. Wish I could do it too, though. And that's the magic words for any capital raiser, because it's like, well, geez, I have the time. If you have money, I have the time. And so I went up and met with this guy, and he put $50K into our next deal as a passive investment. And fast forward to today, that was me and him just bought 2 single family homes. He told a bunch of his friends about us. I started doing more reach outs to other passive investors. Other people started showing up, started a YouTube channel about real estate investing and that kind of thing. And before you know it, we are controlling about 2,000 units of multifamily across the US. We've had multiple full cycle exits. We're blessed enough that we've raised about $75 million of other people's capital. We run a debt fund that issues hard money across the U.S. So we've become a fairly diverse company with our hands in a few different things. And I'm really lucky to be at the head of it. And we also just closed our first hotel this year. So bought a lot of different asset classes and are now diverse enough that we're in multifamily hotels and a debt fund.
Yeah, I love that. I mean, I think there's a ton we can unpack there. And I think that a lot of that diversification has probably been driven by where the market's gone in the past few years, right? As you've expanded. And so we'll unpack some of that. And, just let's start with that. Really, I know as we were talking at the beginning of the show, just understanding kind of, where is the market today? How has
it's not where it was a couple of years ago, brother. I mean, like you go to like 2019 to 2020, to even 21, even during COVID, believe it or not, it was a great time. I bought a 336 unit dead in the middle of COVID. There's videos on my YouTube channel. I mean, my partner's going down to go look at the property, and we're all running around in masks. Like think about like outside in masks. Yeah, that's the world, man. Like now, it looks like Looney Tuneville looking back on it, but looking at the video and all that, it's like, well, I get it. So that was a time, even before we started syndicating for larger multifamily back in 2015. But from 15 all the way up to 21, you had a lot of equity looking for a home. Right. It wasn't that hard to raise money. It was work like anything else is, but if you bought a deal, you had a world where rents were annually increasing, expenses were stable enough, right? And debt was cheap. Debt's been cheap like in all of the 2000 teens, all the way up through 2022. Money was cheap. It was very easy to get money. You get money, you get back. I have mortgages that I got at 3% on big multifamily properties, right?
Mhm.
Try and
Yeah.
find that debt now, right? So now what's happened is there's been stagnation in income growth. Nobody really talks about that, but it's true. And especially in Class C, Class B real estate, income has been stagnant for years. And so that's happened. The value add game of multifamily just doesn't work anymore. So you're not going to go in and buy a multifamily asset that's renting at $700-800 a month and push rents by $200 by putting in stainless steel appliances and new LVP flooring, right? That used to be the game, and you could get it because many Americans weren't spending at their financial capacity for housing. Now they are, right? And so you're not going to get to that. You can't play that game anymore. So that's what we're facing today is the value add game that made multifamily sexy from 2022 and earlier is not on a game. You can't play that game anymore. It's not there, right? That's number one. Number two, debt
Now,
used to be, sorry.
how much of the value, because I'm going to disagree with you there because
Oh boy,
see
I
opportunity.
love it.
I
What?
think I'm curious what markets you're talking about when you say value adds dead. Is it dead in the Southeast? Is it dead out West? Is it dead everywhere?
We're in the Carolinas. I'll tell you where we are, right? We're in the
Okay.
Carolinas. We're in the Southeast prevalently, right?
Okay.
And the reason why I say it's dead is that it's been played a lot, right? Especially in C and B class. I'm sure there are exceptions and outliers and to every rule, right?
I'm in the Midwest, so it's
Yes.
a different market, right? Indiana and Ohio primarily. And we're still seeing a lot of it. I mean, we're actually seeing it start to come back now, but we're also seeing rent growth continue.
Yeah.
I think it's cool we haven't seen the big run-ups of some of the others. So we're still seeing good opportunities from even in 70s product that just hasn't been touched. And so it's just interesting. I think it's market specific. And I think it's, obviously there's opportunities everywhere, but I don't know that I would say it's dead, at least not where we are.
Yeah. But the financing doesn't work as well on larger deals, right? Because like back then, you could buy under bridge debt at 3-4%, where the bank would go in and they'd give you, between 75 and 85% of acquisition plus 100% of construction, right?
For sure. You got to bring more equity to the deal. That's right.
Yeah, that was a great equation. And if you got to bring more equity to the deal, you got to make sure your deal's got more meat on the bone so you can pay that equity a good rate of return, right? The bring more equity by itself isn't a good answer. Like that now, then your deal has to make more money so that equity can be happy, right? For the deal. We're invested in Minnesota, and I see a different market there. There is more opportunity for growth, but in the Southeast, especially in C and B class, a lot of those deals got absorbed because those became the cool kid markets and the markets that a lot of folks were trying to push into, and a lot of growth happened. There's perhaps growth elsewhere, but if you look at who owned a lot of the C class that hasn't been touched, and everything like that. A lot of it was baby boomers. That's who I bought a lot of real estate from over the last 10 years is baby boomers. I mean, I bought a 49 unit off of a guy that had a handwritten for rent sign in front of the property and was not familiar with Craigslist or Google Pin Drop or any of that kind of stuff. And so that angle is one that has been done, but a lot of those baby boomers have aged out. Baby boomers are now in their high 70s, early 80s, So there is still deals, but you got to find something that's extremely mismanaged or that is maybe a generational held asset. We like the idea. We've pivoted. Where I see opportunities today in the playgrounds that we're in the Southeast and that kind of thing is in buying new builds that were built in the last 10, 15 years where you've got a owner that's either over their skis a bit. Like we bought a development deal from a guy that was halfway done. He started the deal in 2022. Inflation happened, cost of materials went up, interest rates went up. he ran out of gas. So we came in and bought the 36 unit halfway done and finished it. Right.
Yeah.
I see opportunities there for those that where the world thought that things were going to zig and they went and zagged,
Sure.
in that. So that's where I think opportunities are moving forward.
So is it when you say buying an asset, because I could totally agree with you, right? Buying assets that are 10 or 15 years old, I mean, there's a great opportunity there. But when you say that, is that you don't consider that a value add? Are you renovating those, or what are you doing with those 10, 15-year-old assets?
You still, because it's the thing, if it was built 15 years ago, right? What you've got is you got something even like it's even 15 years ago still feels pretty new. It's still dated. It's now ready for a facelift. Those appliances are probably starting to get kicked. The unit's probably due for a fresh coat of paint, fresh flooring, that kind of thing. And so you could do a light lift value add and probably not push rents, $300-400, but you could go in there and invest $3K and achieve a rent increase of $50 to $75, which if you annualize, that's actually still a good rate of return. So it's not buying. We bought a 198 unit in North Carolina in the early 2000 teens. And we were able to push rents $300 a unit because these were old school units with, as you're talking about, with like wood paneling on the walls and very dated, no playgrounds, active drug dealers at the property, that kind of thing. So we came in and turned that property around, cleaned it up. But that angle works, but you don't have to on something built in 2015, let's say, that's what we're looking at more. We see the opportunity in the Southeast more there on newer builds, but stuff that they're still charging what they were charging 5-10 years ago.
Yeah. And we're aligned there. I mean, there's a lot of opportunity in newer assets, just mismanaged assets, even like Class A, that's just mismanaged or managed by somebody that just doesn't have their eye on the ball, right? Isn't pushing things, is just focused on occupancy, has owned it for a long time. Maybe a long time, it's 10 years, but long enough that they've kind of forgotten about it, right?
Yeah.
So I agree with you there for sure. There's these opportunities that we're seeing. So that's kind of on the multifamily front. I'm curious because I know you're in many things. And you mentioned your first hotel deal. So how have you diversified out of multifamily or tangentially, into different types of multifamily? And what was kind of the thesis reasoning behind doing that?
Yeah. Well, we got in a new build as well. I just finished a 30 unit in New Jersey. And so there's a new build angle that we've gotten into at DeRosa, but the new build angle only works as if you got some sort of an incentive, right? I'm talking about like a local public-private partnership incentive. We did a deal, another one in Minnesota, where we got tax credits, like a tax incentive financing TIF. And in Jersey, we did a deal where we got a tax abatement. So the taxes stay the same at the cost of land for years, even though we did a bunch of improvements. That new build works.
Talk about that for a sec, Matt,
sure.
Because so we do the same thing, right? We've done now 3 projects where it's these public-private partnerships, right? With TIF and other things.
Yep.
So explain that a little bit to people, because I do think that's a fantastic strategy. And I think it's a great way to create value right now. So tell people what it means.
Yeah. Well, there's the one lever that a municipality can pull. Like they can throw like big money, like LIHTC, low income, affordable housing tax credits and everything like that. You can do those kinds of things on deals. But if you don't want to restrict rents, the main lever they have is real estate taxes. And so like if I was talking to Robert Beardsley, who runs a company that does a lot of work in Texas, right? And they're renting, if you just rent below AMI, and I've rented 80% of AMI, you can wash out the majority of your real estate taxes. That same program exists in North Carolina, South Carolina, that kind of thing, right? So it's really about understanding what incentives are there for the local municipality. New Jersey, where we did a deal, we did a new build, a 30 unit. It's just the incentive was, okay, if you're going to build new and if you're going to invest a certain amount of dollars, it was your investment has to be over a certain dollar amount that you're going to do in a new build. And you also have to put a certain amount of units online. If you meet meet a housing requirement and do a major investment, because they look at that as, okay, that's jobs, right? Like for people that are going to do work, and there's a labor force that'll benefit from that investment, right? You do those things, we'll lock your taxes at the current amount, which for this 30 unit was like $8,000 a year. We'll lock your taxes at that amount for the next 20 years. So that means that the taxes ought to be 70, 80,000, but they're going to fix them at 8. So that makes the deal pencil. If you didn't do that, the deal doesn't pencil out, right? Now TIF is another way to do it, where like there's incentives to like help to pay your annual tax bill and that kind of thing. You can sell the TIF. It's like a bond in some ways that you can monetize. So there's different ways to skin it, but it's really about like giving you help with your real estate taxes. In essence, is what all these things are.
Yeah. Well, real estate taxes become, I guess have been, but really have become one of the major expenses on a lot of properties.
It can be. Yeah. But that's the lever they have, the local governments do. And if you're doing what they want you to do, which is every place needs more affordable housing, right? And if you're going to do housing that you're going to be providing for people that earn around the AMI, the average median income for the area, there's typically, for your listeners, the tip is to go and find out what the incentive is and how to tap into it. Because the AMI game in North Carolina, South Carolina, Texas, you can apply that to an existing piece of real estate. It doesn't have to be a new build. It can be something that already exists. And then you can go in and lease to people that are earning below the average median income and get heavy incentives for doing it. So I think that's one angle to do newer build things. There's a lot of equations that have to work out, like a lot of boxes that have to get, checked for the deal to work, but it is possible.
That's interesting, especially you mentioned South Carolina, North Carolina, Texas. Actually, have programs where you can get incentives on existing properties too.
Mm-hmm. Yeah.
Interesting.
Yeah. It's there's a lot of hoops. And you got to Google it, right? Like in North Carolina, you got to work with a not-for-profit. You have to find a local not-for-profit for a joint and do a JV partnership with them and everything like that, which is all stuff to deal with. We've also gotten ourselves into hotels because I love hotels. I like the cash flow that comes from a hotel. Multifamily is a great game to leverage appreciation because of the low cap rates that most multifamilies have. But hotels don't have the same cap rates. They don't trade at very, very low cap rates, where like for a hotel, you're not going to increase your NOI by a little bit and have big property value change as you would a value add multifamily deal. In a hotel, they typically make money day one, which is tough to see a multifamily that makes a good cash flow to investors first day. The hotel we just bought produces 9% to our investors the first day you close. It's tough to find that on the open market. For a multifamily anyway.
Are you buying or building hotels?
No, we bought an existing. We bought one that was built 5 years ago. The equation I like is anything that was built pre-inflation, because I think that inflation will eventually push up costs with regards to cost to stay in a hotel or cost to stay in a multifamily, for things that were built after about 2022. The hotel we just bought still feels and smells and looks new, but it was built in 2018. And we bought it at a value that was about 70% of what it would cost to build it today, only because of inflation.
That seems like a great investment thesis.
It's got to be the right equation. Yeah, that's a good one. They're not all like that. We had to kiss a lot of frogs and look at a lot of different deals to find that one, but we finally did.
And what's key when you're looking at a hotel? I mean, what are the main drivers? I mean, I'm assuming it has a lot to do with location and kind of proximity,
All location,
highways, and different things.
It's all location. It's about the flag. I'm not a boutique hotel guy. These are branded hotels with, Hilton, Marriott, Wyndham, those brands on them. IHG, those guys. That's Holiday Inn. But those are those are the hotels that we like doing. We're looking regularly at more branded, flagged hotels in good locations. And we like hotels that are what you would call limited service. This is like the Hampton Inn Express, the Home 2 Suites, those assets that are like kind of mid-tier. I'll give you an example. The ones where you go and you have to have these things: a free breakfast in the morning, a gym on site, a pool on site, and it's got to be close to some sort of like right off a highway, where people can see it. Even better if you can see it from the highway. And it's got to be near some other sort of employment center, that kind of thing. The one we bought in Houston is a mile from the Houston airport and near a lot of the other, it's near Halliburton's it's on the same block as Halliburton's headquarters. It's near a lot of other employers that bring people in and out, traveling consultants, or who your primary resident's going to be, and people like me and you that have kids that want, if we're traveling, I don't want to deal with breakfast. I don't want to have to think about that. I don't want my kids to go swimming in the pool. I don't want to give them a free breakfast. Check. If I'm traveling with just my wife, I'll stay at the Four Seasons, but I'm not going to do that if I've got kids and the whole thing. And most Americans can afford to stay in a limited service hotel, which in Houston, for example, rents for like 120, 130 a night.
Sure. No, it's interesting, man. Definitely compelling. What else are you working on? I know you got a few other things.
Yeah. What I try and assemble for my investors is a means for people to make cash flow and also enjoy appreciation. So some multifamily deals that we have appreciated very, very well. Some that we bought, late in the 2020 cycle did not, or have not appreciated because we kind of, just like everybody else, kind of got caught in the wind of rate changes and that kind of thing. But those are all appreciation plays. What I like a lot as well is blending in cash flow. And so that's why our debt fund is yielding cash flow. Our investments in hotels yield cash flow. I think that we're going to be going towards more of a investment cycle where investors are going to be more excited about cash flow than they are about the promise of future appreciation. And so we're leaning more into cash flow investments that might not yield 15, 20% IRR, but there's a clear schedule to get people to high single digit cash on cash returns with a potential to make in the low double digits, like, 10, 11, 12 with more security. I think is going to sell better than the potential to make 18 maybe in the future.
Yeah. I'm curious. I want to come back to the debt fund because I think that's interesting.
Sure.
But something that popped in my head is cash flow. Like I understand it. I love cash flow because like that's what you live on. But I find a lot of people, at the end of the day, they want that big pop. They want that appreciation. And especially in an environment where, like, how do you sell your cash flow against, like, the stock market, right? As we keep hitting these new, just AI-driven highs, right? As much as you might think it's a house of cards or don't, like, we hit these new highs, folks can put their cash in there. How do you sell them on, hey, 9% cash flow? That's all you need.
Yeah. Well, okay. A few different things real estate gives that the stock market has no ability to give. Number one, above all else, is income tax incentives, through cost segregation studies, through negative depreciation losses and negative K1s and that kind of thing. That's a huge benefit that we can give. We can also give collateral. Because you could own WorldCom stock or something like that went to zero. Like NVIDIA could go to zero. It could. As much as like, I know that's like a gasp. Oh my goodness, NVIDIA. No, that's our darling. Well, it could, And then and you can't go take the CEO's house if it does go to zero, right? Whereas in real estate investing, you do get collateral, especially if you're investing in things like private debt, or if you're investing in equity where there's at least some sticks and bricks. You get a higher chance of getting your money back, or at least some portion thereof, because of the sticks and bricks, the hard asset you're getting yourself involved in. So those are some of the things that real estate brings that the stock market can't bring any way you slice it. Beyond that, you also get leverage. I can buy a $11 million hotel and borrow $8 million from a bank. So I borrowed almost all the purchase price. So I only have to bring in a little bit of equity.
Yeah. Well, there's a little bit of softball for you. I knew you'd nail it, but
Sure.
But it's a common discussion. I
get that all the time. And I tell people like, hey man, okay, so what's the stock market going to do tomorrow? You know, I don't know, right? I mean, who knows? You're right. You don't know. Like, there could be some bad news that had nothing to do with anything that you're involved in, and the stock market could drop 10%. You know, all these things are possible, but there's more collateral and recourse in real estate than I think the stock market gives you. And yes, there's stop limits, and yes, you can get fancy pants and use derivatives and all that stuff, but you still are more naked with stocks than you would be with real estate, I think.
Yeah, I think well said.
Yeah.
So you said something as we were just getting started that it's kind of what'd you say, tale of two markets? I didn't hear exactly what you said, but it's kind of this idea of there is this kind of, I don't know, dichotomy out there where you've got the, so you got really good, you got really bad. There's not a lot of in between. Like, I wanted you to unpack that a little bit for people. Cause I mean, in some ways I feel the same way about kind of where we are right now.
Yeah. Well, we're in a changing cycle, right? We're in a market where, some real estate deals aren't going well, and you're in a market where deals that were bought earlier, like I'm selling a deal right now that we bought in 2017, and we're returning 4x investor principal. Think about that. Like, that's awesome. I'm super grateful to have that deal, and I'm only able to pull that off because we owned it for so long, right? We owned it for almost 8 years, right? So then you got stuff that all friends I have that you probably know too, that bought stuff in the last 3 years, and they're like, geez, man, we're running out of gas here. Like the car is starting to sputter, so to speak, on some existing assets. And then I'm also seeing an opportunity to get in again into assets, whether that's through distress or whatnot. There are tea leaves that are saying that the Fed is going to keep dropping rates. It's slowly starting to creep down the 5 and 10 year Treasury, which is only going to help us. And so I believe that 2026, I'm always an optimist, that 2026 is going to be a good year. Maybe not a banner year, but a good year for real estate investors, as some of the bad stuff that was bought in the last 3 to 4 years works its way out, and it's got to just get its way out. Banks are going to have to take it back, or they're going to have to do just different workouts with some of the buyers that bought at 2021, 2022 prices, and we don't sit at those numbers today, right? Beyond that, I also think that debt is going to get back and be more affordable, and I think that there will be opportunities to get into things again. So I think that's what we're at. We're in a workout, but maybe potential for new energy change. And one more thing to throw in there on the bad side: equity is so burned right now. It's very tough. It was a slug for us to raise the money for the hotel that we just closed, even though it was a great deal. A lot of equity that we've talked to is just burned. They're tired. They're going to just hole up and sit on their cash and take the returns they're getting in their CDs.
So deals that haven't sold, right? That were supposed.
What's that?
Or people are still in deals that haven't sold that were supposed to by now.
Right? Yeah. There's not a lot of liquidity that's ready and hungry in the equity markets. A lot of the money's either, like you said, locked up. I just got a call. I just had a call before this with one of my biggest investors, and he's tapped out. He's like, I don't have any, everything I have is in things. I have assets, but it's all tied up. And so he's illiquid for anything new right now. And so there's I think a change on the equity side that needs to happen, that means there'll have to be some shakeout, some things that'll have to just work its way through, or new equity will have to come in. newer investors that did not invest in real estate before, will have to start getting into the market.
Are you seeing that? Like, are you seeing more new investors or broader market of investors come in and be interested in real estate, or is it the opposite?
No, I'm not. I'm not seeing new money yet. I'm seeing a lot of people that aren't accredited show up and say, "Hey, do you have anything for non-accredited?" So I think that if anybody listening is looking to do a non-accredited deal, that's where I would go right now, because I think that just do like a small onesie twosie, top side, maybe 2-3 million capital raise. And if you set it up for non-accrediteds and don't solicit, don't do a bunch of social media marketing or whatever, I think you could do well. That's where I think a lot of new money is going to be. I'm not seeing new sophisticated accredited investors show up right now. I think those folks got into something in the last 3 years and are kind of waiting on things to work their way through. So some of my existing investors a lot of them are dollar cost averaging, are just continuing to throw money in to deals that we and other people have, knowing that it'll all wash out.
Mm,
Yeah.
Interesting. So where do you, where do you see people we're in this transitionary time, right? It sounds like, as you're looking at deals or as you're thinking about things, or where do you see people getting caught? Like, what are the things to avoid right now?
Oh, going in undercapitalized, meaning like not enough cash. I think that there's going to be a lot of changes that are going to happen in the next couple of years. Like I had a student syndicator that I work with had a deal, 50 unit he was closing on, and his operating reserve, meaning the amount of money he just has is going to sit on the shelf and just cash, was so low. It was like less than 1 month's expenses. Because we're cash flowing so high, it's 95% occupied. We don't think we're going to need a big reserve. And I was like, listen, you just don't know which way. And he was fixed rate debt, all the things, all the boxes checked. But I encouraged him to raise like 4 to 6 months worth of expenses to sit in operating reserves, because just I feel like the wind is not. We're not sure where the wind's going to blow the next couple of years, and with rates and nobody saw insurance going up as much as it did, but that could happen again. I think there's a lot of things that could happen. Major recession, his occupancy could have gone from that, and he did. He listened. I just modeled it out. I was like, let's pretend occupancy on your deal goes to 80%. What happens? So, we wouldn't be able to make any cash flow. We'd be just barely above the debt. Great. Well, wouldn't you want to have some operating reserve just in case? And I modeled out a couple scenarios that could cause his occupancy to drop. So I think that's the biggest mistake, is assuming that the changes that are going to come to the world, rate changes, COVID, all that jazz, that it's all gone. I think that we're like 5 minutes late on the next black swan event that nobody ever saw coming, Yeah. I think that you better have enough money to handle a black swan, because I think that we're due for one every other year, it seems like,
It does seem like they're accelerating, right?
Yeah.
And to your point on insurance, I think we continue to see the amount of just natural disasters, right? $1 billion claim events continue to
Yeah.
increase. It's
I think I don't know. My prediction on insurance is we've actually seen it come down a little bit, because knock on wood, man, we've been very lucky to not have a major hurricane hit the US in the last couple of years, right? Because of that fact right there, the cost of insurance we've seen drop a little bit, not back down to where it ought to be, but we've seen 15% reductions and stuff like that. We also had another low hurricane year, because we're officially out of hurricane season, right?
right.
So I think that we'll see insurance creep down a little bit. If we get clobbered like we did a couple of years ago with 3-4 hurricanes hitting Florida all in 1 year, right? Then that'll push not just hurricanes, but just things like natural disasters are going to push insurance up. So I think we'll see a windfall for insurance. But other stuff like income, I've heard more and more municipalities pushing real estate taxes because they're late to the party. They realize, all the real estate you and I own really ought to get revalued. So I think that real estate taxes is going to be another battle to fight in the next couple of years too. So
yeah, we've been actively appealing,
you got to do that. You got
making
to
our
do that.
decisions.
Yeah.
That's good, Matt. I mean, what do you think from an LP perspective? What do LPs or the passive investors, right? What do they need to be paying attention to right now? What do they need to be doing a better job of vetting in the climate where we're at now?
I would, if I'm, and I'm an LP also. I pass invest too. And I look for, operator experience. They've been around for a bit and everything like that. I look for asset diversity. I actually like more funds these days versus single asset syndications. I think that we're going to see more funds come into the space in the next couple of years because organizations like TribeVest Invest Clearly and Fractional are going to allow for more and more syndicators to break big deals down into smaller chunks or do sub syndications, that kind of thing, and offer up more funds. Avestor is another one. And so I think that you're going to see more and more funds come in. And I like the fund model because then it's like, well, you're not betting that just that one asset's going to go well. You're hoping that, 3 of the 5 assets in the portfolio are going to go well, or there's somebody goes and raises a fund that's going to own 10 multifamilies. You hope that at least half of them do well, and the other ones can be okay. They can be mediocre. They can even lose. But if the ones that you got into, if some wins happen, a fund at least protects your downside. And so I think if I were a passive, I'd be looking way more at funds with seasoned operators versus onesie-twosie syndications.
Yeah, and I totally understand the portfolio theory of like you invest in a few and a few do well and you make out, all right. I have a lot of investors who say like they don't like funds. They like single assets. They like to be able to touch it, look at it, evaluate it. They don't want to just put it into like a black box, right?
Yeah.
So, I mean, are they overvaluing like their ability to judge the success of any one deal, or what do you think that
Yeah.
what is that perspective?
But if you go into a fund, it really comes into the fund valuations, right? What's the fund terms? Like my debt fund is liquid after a year, right? You're not going to have that with a real estate holding fund. You're not going to be liquid that soon, but you could see liquidity. Like I see operators out there with a 3-year liquid fund, where you can get liquidity after 3 years or even 4 or whatever. So I'd look to see what the liquidity terms are. If the operator's been raising capital, on a regular basis, and valuations. There's a concept called a NAV. A net asset value. You want to see how often they're going to be doing a NAV study. And that my debt fund, it's easy. Like, well, how much are the loans out for? Add it all up. That's what your fund's worth. But if you've got a fund that's involved in multifamily that's going to be growing over time, you want to make sure that the operator is doing a NAV, quarterly or annual NAV, to tell you what your asset's worth with third-party appraisals and everything like that. That's all. That should be part of the package that they're doing to make sure that you're getting good valuations.
I got it. Well, Matt, this has been it's been great conversation, man. Really insightful.
Thank you.
Our audience, a couple of real world perspectives, which I think is super helpful from hearing what's happening on the ground floor. If folks want to learn more about you and all that you're doing, how can they get in touch with you?
Yeah, they can check me out on the Best Ever Show. I'm one of the hosts of the Best Ever CRE Show, longest running daily real estate podcast, or they can go to my website, DeRosa Group, DEROSA, DeRosaGroup.com. They can go and hear more about everything we have to offer there. They can download a bunch of free giveaways and just education tools and everything like that, checklists, multifamily calculators, that kind of stuff's all at that website too.
Awesome. Well, Matt, thanks for coming on the show today. We'll make sure all that's listed below so you guys can all get access to those great resources. You can check Matt out on the Best Ever Show. And with that, Matt, hope you got a great rest of the day.
Cool. Thank you.